Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. Today, we are going to be talking about your emergency savings and specifically how inflation may impact your emergency savings, because I hear this a lot in this day and age where inflation is becoming a real concern for people. And I want to just clear the air and really make clear exactly what we want for our emergency savings and exactly how inflation may play a part in that savings that we have set aside for a rainy day. So stick around for all that and more in today's episode. But before we get started, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just reach out to me via social media, DM me, and let me know that you are interested in financial coaching sessions, and you and I can begin working together and creating financial goals that are specific to you and your family's needs, and then pushing towards those goals in a reasonable amount of time with the proper plan, and then ultimately helping you to reach long-term financial freedom, which is what I hope for every single person who's watching or listening to this show every single day. So one big part of the financial action plan, it's really two parts, but one big portion of the financial action plan is emergency savings, right? It's having money set aside in an emergency fund so that if something were to occur, if multiple things were to occur that were emergencies, right, that were proper emergencies, that weren't just you didn't have money to pay the pizza man, but proper emergencies, right? If proper emergencies occur and you could not pay for whatever it was just out of your cash flow, then you could use this money in order to cover any emergencies that you may have. Okay, that's a big part of the financial action plan. And the reason that we do this is because we want what I call insurance against tragedy. Okay, you want this money to be in place that will allow you to have some buffer against bad things occurring. Because if you just lived your whole life without any financial buffer, right, without any money in place that would allow you to make mistakes, or would allow you to have an accident, right, or would allow you to just have a bad day and something bad happen, right? If you never had that money in place to do that, then you're always living on the edge of a financial disaster, right? And that's not what we want. We don't want to live on the edge of financial disaster. We want to be living financially free, meaning we have options, we have freedom, we have the ability to do things and not be afraid to do certain things, because we have set up our financial life in a way not to where it's 100% bulletproof and that we have everything covered, every emergency covered 100%, but where, if something were to happen, it's far more likely that we are going to be able to cover it in cash up front than us having to go into debt for it, or having to have a payment plan to cover it, or just being way behind on whatever the cost is. Okay, because there are only a few things that can occur, a few catastrophic things that can occur that would really beat up on my idea of an emergency fund being 4 to 6 months of household expenses. And those things, are obviously like big medical bills, right? Because medical bills can, ramp up and really cause a lot of people a lot of hurt and a lot of issues. And so medical bills can be one. If you get into a big car wreck and let's say it's your fault, and you have to pay out of pocket for some reason for your own vehicle because you only have liability insurance or whatever, right? But even then, you can buy a real crappy vehicle for a low amount of money, and then allow yourself to buy something nicer later when you have money saved up. But nonetheless, right, we have this emergency fund in place for a reason. Now, the dangers of the emergency fund are that we're not growing that money. Right, that money is literally sitting there in a savings account, in a high yield savings account, in a money market account, something like that, right? And it's just sitting there and it is not doing anything, right? Especially right now when interest rates are historically low, right? The money is not doing anything. And when your money is not doing anything, what's happening? inflation is eating away at the purchasing power of your money. Now, what's purchasing power mean? Purchasing power is simply the power to purchase a certain amount of goods and services. So if $100 could buy you a certain basket of goods, okay, and you could purchase exactly $100 worth of goods and services, and then over time, you could buy less goods and services with that same $100. That means you have decreasing purchasing power, right? The power of your money to purchase goods and services is decreasing, and that is what inflation does. Inflation decreases your purchasing power, okay? And so when you set aside an emergency fund, your emergency fund should be based on your household expenses, okay? Now, naturally, if inflation were to increase, then what do you have? You have an increase in your household expenses, right? The cost of food is going to go up. The cost of gas is going to go up, right? You're going to see this increase in the cost of goods and services. And if you see this increase in cost of goods and services, then the money that you have in your emergency savings may not be adequate to cover the emergencies that may come in the same way that it was when you first set it aside, okay? So it is important for us to do a couple things. One, we need to take into account the exact expenses that we are looking to cover, right? Because an emergency fund is really in place if you, again, if an emergency occurs, but, if you lose a job, if you, lose your income for any period of time, the catastrophic case where you can't pay for anything and you have to have this cover your household expenses. Okay, so we want it to cover 4 to 6 months of household expenses, because typically people can lose a job and then subsequently find a job within a 4 to 6 month period and then be back on their feet with their income. And that way that emergency fund will bridge the gap for them. But the problem is if you have the same emergency fund setting aside for years and years and years, and it's being eaten away at by inflation, and let's say you were on the low end, 4 months of expenses, right? And let's say you've had the same emergency fund setting aside for the last, 10, 15 years, okay? Which is great that you have an emergency fund setting aside, but let's say you had it setting aside for the last 10 or 15 years, and let's say you lost your job. Well, the likelihood of you being able to cover 4, 5, 6 months of household expenses is going to be far less now, because the cost of goods and services has increased over time. And the fact that it has increased means that the purchasing power of your money has declined. Therefore, what we have to make sure that we do with our emergency savings, with our emergency fund, is to subsequently add a little bit of money from time to time to those funds, simply as a buffer to inflation. Okay, and again, inflation is not a super high number. Okay, inflation is not anything crazy, but we need to maybe on an annual basis or every couple of years reevaluate the cost of our household expenses. Okay, and this also it plays into if you increase your standard of living over time, because if you increase your standard of living over time, then you also need to be increasing your emergency fund, because your 4 to 6 months of household expenses is changing, and anytime that changes, then we need to make the proper adjustments. We need to add some money to the emergency fund, and you can do this in multiple ways. You can do this in one big lump sum, where you just lump on a lot more money to your emergency fund, or you can do this in a systematic way where every single month, let's say you're putting an extra $50 towards your emergency fund, or whatever it may be, just continuing to add to that buffer that you have between yourself and tragedy, that insurance against tragedy. Okay, but what inflation also leads a lot of people to want to do is to invest their emergency savings, which I tell you not to do. Okay, and you may say, well, why in the world would I not invest my emergency savings? That way I can grow that money. I can have that money increasing in value for me at a pace higher than inflation. Well, the logic seems to work until you think about exactly what emergency savings are to be used for, right? Emergency savings, again, are insurance against tragedy, okay? Now, insurance against tragedy. Insurance is not an investment, okay? Insurance is something that we pay for to protect our assets. Investments are our assets, right? So this insurance that we're paying for by putting money away into an emergency fund, right? It is protecting our assets. It's protecting us from having to liquidate our other investments. It's protecting us from having to, have no money in the bank. It's protecting us from having to sell our home and downsize and use the equity in our home to pay for something, right? It is protecting us in that particular way, okay? So we don't need to be investing this money, okay, because you aren't investing insurance, okay? Insurance and investments are different things. But on an even larger scale, the reason that we're not going to invest that money, okay, is let's say that it is January of 2020, okay, and you've got your emergency fund in, let's just say, an S&P 500 index fund, all right, and everything's going well, and your money's growing a little bit, and everything's good, all right, and then let's say March hits, and when March of 2020 hits, what happens? Well, the stock market subsequently crashes. Okay, and when the stock market crashed, it lost more than a third of its value. Well, let's say at the same time, because a lot of people let's say at the same time you lost your job. Okay, you no longer had any work to go to every single day, and if that's the case, you no longer had income coming in. Okay, and you were going to have to live off of your emergency savings for some period of time. Well, you got a double whammy. Not only are you going to have to use that emergency savings now, that emergency savings is now worth 1/3 less than it could have been worth if it were just in some high yield savings or some money market account over time. And your argument may be, well, Dylan, that's one particular time period. That's one particular time when that happens. And, the stock market grows over time, and, you could be growing your money. And look, I agree. I understand. You want to have money growing for you. I get it, right? If anybody understands compound interest, I understand compound interest, and I understand the power of putting money away and growing it over time. But what I also understand is that if I were to tell you, hey, it's okay to invest your emergency fund, and the very next month you go out and you have your emergency fund invested and the market crashes, by half, right? And then you lose your job and you have to be using your emergency fund and you don't have as much there to use, right? You're going to look at me and go, oh, well, you said that I could invest it and everything would be good. Everything would be fine. Everything is not good. Everything is not fine, because we're trying to follow the investment rules that I've given you before. And I've told you that if you can't put money away in investments for 5 years without touching it, then you should not be investing that money. Now, you don't know when emergencies are going to occur. All right, that's the problem. You don't know when emergencies are going to occur. But the truth of the matter is that emergencies could occur tomorrow. They could occur next week. They could occur next month, or they could, be 3 years down the road. But emergencies are sure to occur. All right. But if you can't for sure put that money away in your investments for 5 years and have that money setting aside just in case you need it, right, then you are going to have to have that money setting in a high yield savings or a money market account or something, right? You should not be investing that money. It is not proper to be investing that money over time. Even though we want to keep up with inflation, even though we want to allow our money to grow, an emergency fund is not there to grow for us. The emergency fund, again, is insurance against tragedy. Let your investments be your investments and your insurance be your insurance. Okay? Now, do I want you to make as much as you can on this money when it comes to it being in a high yield savings or it being in a money market account? Of course I do, right? I think all of you should be trying to find a high yield savings that offers a good rate of return. But even that is so difficult to find right now because interest rates are historically low. And what happens is when interest rates are really, really low, then that means that banks can't lend to each other at a high clip, right? And if they aren't lending to each other at a very high clip, then they're not going to just give you free money at a very high clip, right? They're going to decrease the rate at which they are going to be giving you money for your deposits, okay? And when they do that, the rate on your account drops and you are going to be making less interest. So it's very, very difficult right now to find good high yield savings or find good money market accounts that are paying anything adequate, right? So right now we're really looking at just having our money sit there, but that's okay. We cannot forget the very, very vital importance of the emergency fund, okay? And I understand it's a substantial amount of money, and it's a substantial amount of money that if you were to put it away and let it grow for 30 years or whatever, then you'd have X amount. I get that, okay? But what I also get is that if you were to get cancer tomorrow, God forbid, right? If you were to get cancer tomorrow and you had all these huge medical bills, what are you going to do, right? If the stock market were to crash tomorrow and you were to lose your job, what are you going to do? Okay, you need that money setting aside, ready for any emergency that life may throw at you. That way, you can try to pick up the pieces of your life, pick up the pieces of the situation as quickly as possible. Because there's nothing worse than having something negative occur in your life and then have to worry about money through that negative thing, right? One of the most glaringly obvious examples that I can think of is when somebody has a family member that passes away. Right? You've seen it all the time when people have a family member pass away and they are grieving the loss of this family member. But the problem is that they are also struggling to come up with the money for the final expenses of this family member. Okay, so they may, try to raise money online, or they may ask somebody for money, or, they're scrambling, trying to get the money together and do things as cheap as possible, right? But if you had an emergency fund, or that person had an emergency fund, then you could be in a place where, hey, this emergency happened, this thing occurred, and we can take care of this thing real quick, and we can get back to this grieving process, right? And not have to, worry about money so much. We can actually worry about the thing that is at hand and not the thing that is secondary, yet we put primary because people are always going to be asking for their money in that process, okay? So it's very, very important that we set our emergency fund aside, because it can cause a lot of pain if we don't have one otherwise. Now, when it comes to other options for your emergency fund, other things that you could put your emergency fund in, I just want to hit on a few of these, and I've talked about them before, but I want to make sure that you guys understand that these are not really good options for you to be putting your money away into. A couple, the certificate of deposit is just not something that you should be putting your emergency fund in. The CD, right? Because CDs, not only are they offering low rates right now, because everybody's offering low rates right now, but if you are trying to get some higher rate on a CD, you're going to have to lock that money in for some period of time. You're going to have to give it to the bank, right? And let the bank pay you some interest rate. And if you break the contract, then the bank can penalize you. And we don't want to be penalized on our emergency savings if we need it. So CDs are a no-go. Why can't you just keep it in your checking account? Well, the easy answer is that can start to really look like extra money in your budget. It can start to really look like money that you just have setting aside that you can spend on XYZ, and it is a slow fade. It's a slow drip when you have that money in your checking account and you see that you can just spend it, right? And you can just spend a little here and a little there, and before you know it, you're eating away at your emergency fund just on your month-to-month spending, which is not what we want. So we want the money to be separate from your checking account. You want it to be in a savings or a money market. And some people even say put it in a savings account that's not in the same bank as your primary checking account. Now, the reasoning for this is because nowadays with electronic transfers and everything, it takes moments to take money from a savings and put it into a checking account. And given that that is the case, then there's very little friction between your savings and your checking account, meaning that it's going to be really easy to spend money that may be in your savings account if you are a spender. Okay, if you have those tendencies, then you may want to put that money in a separate bank with some separate savings account that is not tied to your primary checking account. But my emergency fund, mine and my wife's emergency fund, for instance, is in the same bank as our checking account, but it's just something that we don't touch. Right? It's an amount of money that's over there, and it's just off limits. It's an off limits amount of money, and that's perfectly fine by me. Okay, I'm not wanting to touch that money, and hopefully I don't ever have to touch that money other than systematically adding to it in small amounts over time. Okay, but I don't want to touch that money, and if you think you would have a problem touching that money, then you should separate it and add a little more friction to your life between that account and your primary checking account from which you're paying bills and spending money on a regular basis. Okay, so checking accounts, just not a good idea. Savings bonds are another particular asset that I just don't think it's a good idea in order to put your emergency fund in a savings bond. First, savings bonds again are not earning anything, right? They're not something that you're going to be able to just put your money into and get your money out very, very quickly, right? It's going to be quicker than some other things that you can have your money in, but it is going to be even slower than if you were to put your money into traditional investments or stocks or bonds or other things, right? Savings bonds just add a little more friction, add a little more problem to you getting your money, but otherwise, they're not going to offer you anything really different from any of these other types of accounts. So money market accounts and high yield savings tend to be my preference when it comes to where do I need to put my money for my emergency fund. But otherwise, you can look at any other number of options, but that's really the only two that I think would serve your needs for an emergency fund in the best way. Now look, the emergency fund is a very fundamental part of your financial action plan or any financial plan that you need to be working. The emergency fund is a very, very large part of it. Or if it's not, it absolutely should be. Okay, and given that this is the case, right, we need to be able to put time into making sure that what we have is adequate. Okay, we need to put time into making sure that we have an adequate amount of money in the emergency fund if something were to happen. Okay, we need to have that money set aside, and we need to have the discipline to not just go and spend that money. We need to have the discipline to set that money aside and not confuse that money with spending money, and not confuse that money with money that we can frivolously put in any other number of baskets that we may put money into. Okay, we need to be putting away money into an emergency fund so that we can buff it up a little bit. That way, if inflation is going to continue at a high rate, because inflation has been increasing, right? If you don't know this already, inflation has been increasing, and you can see this. This is a very real thing in the cost of goods and services. Gasoline has jumped 20% during the pandemic, and in many places it's jumped more than that. I remember at the beginning of the pandemic, we saw gas prices that were, under $1 in some places, and now you're looking at gas prices that are pushing $3 in most places, or maybe even more than that based on where you may live, right? But gasoline has jumped at minimum 20%, and then something as simple as bacon is up 18.7% in price, and these are substantial spikes in price. And the Federal Reserve says that this is transitory inflation, meaning that it's going to go away. It's only going to stick around for a little while, right? But what if they're wrong? And a lot of people do think that the Fed could be wrong on this particular thought process, on this particular topic of inflation. And if the Fed is in fact wrong, if they are incorrect in their calculations, which it wouldn't be the first time, then what's going to happen is that inflation may run a little wilder. And if inflation does run a little wilder, it's going to decrease the purchasing power of your dollars, of the money that you have, okay, of the money that you have setting aside. And that doesn't need to be the case. You need to have your money setting aside, and even if it is getting decreased in value, you need to add to it systematically. And you may say, well, I could just get around that by growing it. We've already discussed that. You don't need to be trying to grow that money. And some people may say, well, maybe I should put it in something that doesn't have any type of tie to inflation, like Bitcoin. Right, Bitcoin is something that maintains its value, right? Or gold, right? Gold maintains its value. Don't do it, okay? Because the volatile swings in things like Bitcoin and gold and other cryptocurrencies are just going to leave you wanting. They're just going to leave you frustrated with the fact that you have put all this money into it, and if you see some crash in the price like we've recently seen in Bitcoin and Ethereum and things like that, and then you need your emergency fund out of that, it's going to be way worse than putting it into any investment account and any traditional investments that you may put your money into. So keep that off the table as well. We are paying for things in dollars still, so we need to make sure that we are saving our money in dollars. And I understand we just don't want inflation to eat away our money, and we don't want our money to just sit on the sidelines. But this is going to be a very small part of what you do over time, okay? The money that you put away in your emergency fund is a necessary evil. It's a necessary thing that you need to do to make sure that you don't have emergencies that come along and ruin your life, that these emergencies can just be little blips on the radar. Okay, so it needs to be something that you do, and then you don't have to think a ton about it. Just buff it up a little bit over time, allow it to keep up with inflation at minimum, okay, or the costs of goods and services within your household at minimum, right? And then over time, you can see that the emergency fund will allow you some freedom to do things that you need to do in your financial life and do things that you want to do in your financial life without the worry or without the stress that may come along with them traditionally. Things like investing large portions of your money into retirement accounts that lock up your money for some period of time, and if you wanted it out, you would be penalized. A lot of people don't want to do that because they don't have money setting aside. They don't have an emergency fund, and they're like, I don't want any limitations on my money, right? Where you could get big tax advantages by just investing into those tax advantaged IRAs and 401ks and things like that, right? It can also give you the freedom to spend money on frivolous things, right? If you want to go on big vacations, then you can go, because now you have this money setting aside. If something were to occur, then you don't have to worry so much about having no money after you go on a vacation. You can have money still setting aside for emergency situations. I'm just saying this is a large part of what you need to do financially. Okay, for years and years and years, some of the baseline ideas of financial management, of money management, have been get out of debt and save money. Okay, and saving money encompasses the emergency fund. It needs to be there, right? We wouldn't talk about it, and I wouldn't have made so many episodes on it if I didn't think that it were so vital to your life. And don't worry so much about inflation eating the value of your money that you do something dumb with the money and end up losing a large portion of it or not having it there when you actually need it. Because if nothing else, what we want from this money is that when we need it, it's there. Okay, it's reliable, it's there in the amount that we have and the amount that we need, and we can just take that money and do what we need to do with it and not have many worries. I want you guys to be protected against tragedy. I want you to have savings. I want you to have some money to your name. I want you to have some money actually set aside that you can do things with. And look, you can give me all the arguments for growing it that you want and all the arguments for not having it in dollars that you want. But when it comes down to it, I know that at the end of the day, if something negative were to occur in my life and I had to pay for it out of pocket, then I would go into that emergency fund that I've done exactly what I've been telling you guys to do with it in today's episode. And I can just take that money out, pay for it in cash, and go on with my life. Even though it's painful, it's just a blip on the radar and not any large thing that is going to keep me from long-term financial freedom. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below that you would like, and I'd be glad to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just go to any of my social media accounts, DM me and tell me that you are interested in financial coaching sessions, and you and I can begin working on creating financial goals that are specific to you and your family's needs and pushing towards those goals over the long term, and then ultimately getting you to a point of long-term financial freedom, which is what I hope for everybody who watches or listens to this show on a daily basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for watching this episode of Money's No Object. I'm your host, Dylan Howell. God bless.